I'm Randy Efron from Skylattice Property Capital, and this episode is part one of a three-part series about CMBS loans for commercial, multifamily, and hospitality real estate. Let's get started. First, you should know that CMBS is an acronym for Commercial Mortgage-Backed Securities. Commercial mortgage-backed securities, or CMBS loans, are generally used to finance stabilized properties that a property owner intends to hold for 5 years or longer. After a CMBS loan is closed, the loan originator contributes it to a pool of other loans that are then bundled together and securitized. Securitization in layman terms means that the pool of loans is figuratively chopped up into pieces with varying risk and return profiles. Those loan pieces are then converted into bonds and sold to fixed income investors. Post-securitization, a master servicer takes over the responsibility of the loan servicing. The master servicer effectively becomes the face of the lender that borrowers deal with throughout their loan term. Sounds kind of complicated, right? CMBS loans are definitely more complex than conventional bank loans, but they come with certain advantages that motivate borrowers to use them. Some of those advantages are: 1. Long-term fixed-rate financing. 2. They offer high leverage. 3. They are non-recourse loans. And 4. CMBS lenders may require lower net worth and liquidity for their borrowers than conventional lenders. With that being said, CMBS loans also come with certain disadvantages, such as the following. 1. Higher interest rates than recourse financing from a bank. 2. Higher closing costs because the legal documentation tends to be more complex. 3. More burdensome financial reporting requirements. 4. The fact that the borrower must deal with a master servicer during the loan term rather than the banker that originated their loan. 5. Strict and expensive prepayment penalties. 6. An interest rate that is usually not locked until shortly before closing. And 7. Lenders may require monthly deposits into rollover and capital expenditure reserves, which decreases the borrower's cash flow. Now that we've gone over some advantages and disadvantages, let's talk about the structure of CMBS loans. Loans are structured as senior liens against properties, and loan terms typically range from 5 to 10 years. Since CMBS loans are used to finance stabilized properties, the primary loan sizing metrics that lenders use to determine their loan proceeds are the as-is loan-to-value ratio and the as-is debt yield. Note that this is different than the as-stabilized LTVs and debt yields that bridge lenders use. CMBS lenders use as-is metrics, while bridge lenders use as-stabilized metrics. This makes sense since bridge lenders are financing properties that have a material amount of upside in the future, while CMBS lenders are financing properties that are stabilized today. I explained how to calculate loan-to-value ratios and debt yields in my prior episodes about bridge loans, so if you need help understanding those concepts, please refer to those videos. Multifamily properties usually have the highest maximum LTV at 75%, excluding mezzanine financing, while hotels are on the lower end of the spectrum around 60 to 65% LTV. Similarly, multifamily properties usually have the lowest acceptable debt yields of around 7.5%, while hotels usually require debt yields above 10%, although 12% minimum debt yields are becoming more common. Now, in order to prevent these episodes from getting too long, I'm going to stop here and continue talking about CMBS loans in my next episode. If you would like to stay informed about new episodes, please click like, subscribe, or follow. Alternatively, if you want to improve your capital raising process, reduce the cost of your debt or your equity, or add a real estate finance-oriented CFO to your team without incurring any overhead to do so, please send me an email at randy.efron@skylattice.com. Thanks, and I'll see you next time.